All right, let's dive right in. Welcome to this explainer, where we're going to unpack a really critical structural failure that's currently unfolding right at the intersection of global finance and technology. You see, right now, the artificial intelligence infrastructure boom is moving at a scale and velocity that the global insurance market simply cannot keep up with. For those of you in the C-suite managing risk, allocating capital, or building digital infrastructure, you already know this isn't just an insurance headache. This is literally a fundamental bottleneck to the AI revolution itself. So today, we're going to explore exactly why the current market is structurally unable to meet the demands of modern data centers, and what that actually means for the largest companies on Earth.
Here is our roadmap for today. First, the hyperscale infrastructure boom. Second, the construction capacity ceiling. Third, operational cyber and grid threats. Fourth, the captive retention shift. And finally, number 5, future scenarios and market evolution. Starting off with Section 1, the hyperscale infrastructure boom. We really need to start by understanding the macroeconomic driver behind this crisis, which is the sheer velocity of capital flow that followed the launch of ChatGPT. We're tracking the combined infrastructure capital expenditure here for the major tech players. So that's Amazon, AWS, Microsoft, Google, Meta, and Oracle. Back in 2023, that combined spend sat at roughly $143 billion. Fast forward to 2025, and it is absolutely skyrocketed to over $413 billion. And it doesn't stop there. The forecast for 2026 pushes that well past $600 billion. Think about that for a second. These companies have effectively tripled their infrastructure spend in just 3 years, with roughly 75% of that directed specifically at AI capabilities. The sheer scale of the physical build-out required to support those numbers is just staggering, and it's creating an unprecedented accumulation of risk. And it's not just about the money being spent, it's about what is actually being built and where they're building it. AI-focused energy demand is on track to triple to 950 terawatt-hours by 2030. But the real headache for underwriters here is the geographical concentration. Nearly half of all U.S. data center capacity sits in just 5 regional clusters, places like Northern Virginia and Silicon Valley. When you combine that intense geographic clustering with the fact that individual facilities now routinely exceed $1 billion in insured value, sometimes even before the building itself is fully costed, you create a massive accumulation problem. A single localized event could trigger catastrophic simultaneous losses across multiple facilities. Which leads us perfectly into Section 2, the construction capacity ceiling. $5 billion. I really want that number to sink in for a moment. This represents the replacement value of a single modern, large-scale, hyperscale campus currently being built today. Look, these aren't your standard commercial warehouses. These facilities require incredibly specialized hardware. We are talking hundreds of millions, sometimes billions of dollars in NVIDIA GPUs, custom AI accelerators, highly complex liquid cooling systems, and specialized power transformers. And speaking of those transformers, they carry a 12 to 18-month supply chain lead time. So if just one is damaged during construction or transit, it's not merely a practical headache, it's an absolute financial catastrophe because of the associated delays. Now, I want you to compare that $5 billion plus risk to this number right here, $2.7 billion. This is the absolute maximum capacity of the world's largest dedicated data center construction insurance facility, Marsh Nimbus, as of early 2026. While facilities like Nimbus and ON's parallel $2.5 billion program represent some genuine, much-needed structural innovation in the market, they are hitting a hard ceiling. The simple math tells us that the maximum practical insurance limit available falls drastically short of the exposures being built right now. So, what does this all mean? We are looking at an absolutely absurd protection gap. Demand consistently outpaces headline capacity. And what you really must take away from this is that it isn't just some cyclical pricing issue where premiums just need a quick adjustment. No, this is a fundamental capability, modeling, and capital deployment problem. For a $5 billion build, an operator essentially has to patch together multiple towers, use facultative support, and take on heavy self-insured retention. They are effectively playing a multi-billion-dollar game of financial Jenga, all because a single facility market solution simply doesn't exist yet. And if you doubt the severity of the ceiling, just look at this quote. Rachel Turk, the chief underwriting officer at Lloyd's, publicly acknowledged a $20 billion single-risk line requirement from hyperscale operators, stating plainly that no market mechanism currently exists to deliver it. This is a profound validation of the capacity ceiling. The gap isn't a secret, it's openly acknowledged at the very highest levels of the specialty insurance market. Moving on to Section 3, operational cyber and grid threats. And this brilliantly illustrates the next big hurdle, because once these facilities are switched on, the underlying threat mutates into something much more complex and invisible. There's a stark divide in the market's response here. The construction market is relatively mature with those dedicated multi-billion-dollar facilities we just talked about. But on the flip side, the operational cyber and grid failure markets are incredibly nascent and fragmented. Sure, pioneers like Beasley are placing cyber catastrophe bonds, reaching around $670 million and issuing excess of loss covers, but the alternative capital participation is still totally subscale. Crucially, this side of the market lacks the credible accumulation models required to actually give reinsurers the confidence to deploy massive capital. To really understand the stakes of operational risk, look at this devastating warning from 2024. The CrowdStrike outage generated an estimated $5.4 billion in economic losses for the Fortune 500. Yet, a staggering 94% of that loss was completely uninsured. Think about that. Only 6%, roughly $300 million, was recovered through insurance. And remember, this wasn't a fire, it wasn't a malicious nation-state attack, it was literally just a routine software update that went wrong. It proves exactly why correlated, non-physical loss is the defining structural risk for data centers today.
This brings us to a really vital concept: correlated risk accumulation. This is when a single event produces simultaneous catastrophic losses across multiple policyholders and types of policies. Imagine a grid failure in Northern Virginia that lasts more than 72 hours, completely outlasting on-site battery and generator backups. Or imagine a coordinated cyber attack on shared cloud infrastructure. Suddenly, out of nowhere, an insurer is hit with massive business interruption claims from dozens of multi-billion-dollar facilities all at exactly the same time. This is where silent cyber, which is unintended coverage hidden in old property policies, and power dependency converge into an underwriter's absolute worst nightmare. And the math here is stark. Munich Re estimates that a 1 in 200-year cyber accumulation event could generate insured losses of anywhere between $20 billion and $46 billion. But here's the kicker. The total global cyber insurance premium collected annually is only around $15 billion. The ratio of exposure to premium is just completely unbalanced. This is precisely why reinsurers lack the structural confidence to deploy the capacity these AI hyperscalers so desperately need.
Let's look at Section 4, the captive retention shift.
Because of these ongoing capacity failures, tech operators are being forced into a massive behavioral shift. I want you to consider this question as an executive. If you're building a $10 billion AI infrastructure network and the global commercial insurance market refuses, or frankly is simply unable to sell you a policy large enough to protect it, who holds the risk? Well, the answer is you do. Hyperscalers are increasingly being forced to self-insure, shifting massive amounts of risk straight onto their own balance sheets through captive insurance vehicles. Now, this kicks off a highly destructive, vicious cycle. Because commercial limits fall so short, hyperscalers bypass the traditional markets entirely and move their risk into captive retention. Consequently, the commercial insurance market loses out on massive vital premium volumes. But even worse, by missing out on underwriting these colossal risks, insurers lose access to the exact loss data and operational experience they desperately need to build the credible models that would allow them to deploy more capital in the first place. It's a classic catch-22 that keeps the whole market artificially constrained. And finally, Section 5, future scenarios and market evolution. So, how does this market solve this crisis between 2026 and 2030? Well, we're looking at 3 distinct paths forward. In the bull case, we see stable infrastructure and benign loss experiences. This allows alternative capital, like insurance-linked securities or ILS, to comfortably grow the cyber catastrophe bond market to $5 billion, creating a truly competitive market. The base case assumes moderate losses, with captive retention growing as commercial limits slowly creep up, but still ultimately fail to meet top-tier demand. But the bear case? That's what keeps executives awake at night. A major correlated loss event, like a massive cloud outage or grid cascade, spooks the reinsurers entirely. ILS investors withdraw, capacity shrinks, all the way back to 2024 levels, and we see a massive spike in pricing with widening exclusions. The trajectory we ultimately follow depends entirely on modeling progress and actual loss experience over the next 24 months.
Ultimately, the most likely long-term market structure is going to require a tiered approach. Let's break it down. Step 1. The traditional market will handle dedicated facilities for those mid-size builds under $2.5 billion. Step 2. For true hyperscale builds, we're going to see heavy captive retention partnered with ILS-backed excess layers. Alternative capital is just structurally necessary here. Step 3. The emergence of parametric products that trigger automatically on grid failures. And Step 4. Ultimately, for systemic cyber risks that exceed private capital limits, we are very likely looking at government backstops quite similar to the terrorism insurance programs we see in the US and Europe.
Which leaves us with this final pressing question to consider today. Will the insurance market actually develop the robust models and tap into the necessary alternative capital structures to cover these hyperscale values before a major correlated loss event forces a sudden, disorderly repricing? The window for structural intervention is incredibly narrow right now. And the companies that figure out how to bridge this gap, they are the ones who will define the next era of specialty growth and AI enablement. Thank you so much for joining me on this explainer today. I really hope it leaves you with a much clearer view of the risks and opportunities ahead.